Hi everyone, today we'll be going over accounts October-November 2021, paper 2-3, question number 3. This is structured paper 2, which consists questions of 90 marks, and it also has a time limit of 90 minutes. And since question number 3 is of 15 marks, we will be attempting to solve this question under 15 minutes. So without any further delay, let's get started. Petra owns a small manufacturing business and her depreciation policy is as follows. So we're given the non-current asset, plant and machinery, and the depreciation policy is at 20% per annum using reducing balance method. So under the reducing balance method, we charge the depreciation rate of 20% to the net book value, which is the difference between the original cost and the provision for depreciation. Then we're also given the information that a full year's depreciation is charged in the year of purchase. So even if we purchase the month while only 1 month of the financial year remains, we charge the full year's depreciation, but none in the year of sale. So even if during the year of sale, the plant and machinery was used for maybe 11 months or 12 months, the depreciation will not be charged. All right, then we're given the following information in respect of plant and machinery that has been extracted from the books of accounts for the year ended 31st July 2021. So this is our year end. And we're given the details. So for 1st August 2020, we're given the cost of 26,800 and we're given the provision for depreciation of 12,200. Then on the date of 1st January 2021, we purchased a new machinery which had the cost of 4,200 and this was settled by a check payment of 2,450 and part exchange of the machinery that had originally cost 2,500 in September 2018. Okay, let's have a look for this one. So the cost of the new machinery was 4,200, right? And 2,450 of this cost was financed by a check payment. And then the remaining cost was settled by the part exchange of machinery that had originally cost 2,500. So this means that the part exchange of the machinery was valued at just the difference between these two amounts, right? So that's 4,200 minus 2,450. Which gives a value of 1,750. So the machinery that had been part exchanged, that received the value of 1,750. Okay, and then on the date of 31st July 2021, machinery had an original cost of 850 and a net book value of 60 was scrapped with no proceeds. All right, let's have a look at the required question. So for the first part, we need to prepare the provision for depreciation account for plant and machinery for the year ended 31st July 2021. So if we're talking about provision for depreciation, then we start with our already existing balance in the provision for depreciation on the credit side, and we record the provision for depreciation of the disposed assets on the debit side, and then we record the depreciation charge for the year in the credit side again. Then we figure out our closing balance of the provision for depreciation, which will obviously be on the debit side. All right, so let's first record the disposed assets provision for depreciation till date. So we were given that we part exchanged a machinery, right? So obviously we can consider this as a disposal, and we have the date of 1st January 2021. So let's record it on the debit side, because whatever assets that we disposed of, those provision for depreciation should be recorded on the debit side. So the date is 1st January 2021 and we are talking about disposal. Let's have a look above. So the part exchanged machinery had originally cost 2,500 in September 2018. So let's just make a timeline. So our year end is 31st July, right? So this is 31st July 2018. Then that's 2019. That's 2020. And we require the provision for depreciation at 31st July 2021. And what we know is that this machinery was bought in September 2018. So September falls somewhere between 31st July 2018 and 31st July 2019, right? So we can just mark this as the purchase date. Then we are selling this machinery on 1st January 2021. Now this falls in between 31st July 2020 and 31st July 2021. So that's our sales date. And according to our depreciation policy, a full year depreciation is charged in the year of purchase, meaning that for this particular year, even if the machinery was purchased in between the particular year, a full year's depreciation is to be charged. So for this year, we charge the depreciation. For this year, obviously, full year it was used, so we're going to charge the depreciation there as well. But we know that depreciation is not to be charged in the year of sale. So even though we've used the machinery for a couple of months, we do not charge any depreciation for this last year. So we just need to figure out the depreciation for these two particular years and add it up and figure out our provision for depreciation. So let's figure out the depreciation for the first year. The rate of the depreciation is 20%, and the method is reducing balance method. But since in the first year there will be no provision for depreciation, we can easily apply the rate to the cost. So that's 2500 times the rate of 20%, which we can write it down as 0.20. So this gives the first year depreciation to be 500. Let's figure out the second year depreciation now. For a second year, we obviously have the provision for depreciation as 500 now. So we need to reduce it from the cost and then multiply it with the rate of 20% in order to figure out our depreciation charge for the year. So that's 2500 minus 500 times the rate of 20%, which we can write it down as 0.20. So this gives the depreciation charge for a second year to be 400. Alright, so these are the amounts that we require. Now in order to figure out the provision for depreciation, we just add up the depreciation charge for these two particular years. So that's going to be 500 plus 400, which gives us the total of 900. So this is the amount that should be recorded on the debit side of our provision for depreciation account. Let's do that right here. Okay, now we can move on to another date. So for 31st July 2021, we have machinery with an original cost of 850 and the net book value of 60. Was scrapped with no proceeds. So as we know that the depreciation is not to be charged in the year of sale, we just consider this amount while figuring out the provision for depreciation. Alright, so we know that the net book value is just the difference between cost and the provision for depreciation, and we are given the cost of 850 and the net book value of 60. So it is quite easy to figure out our provision, right? So let's just substitute the values. So net book value was 60. Cost was 850. We need to figure out the provision. So this is just going to be provision equals to 850 minus 60, which gives the required provision to be 790. So this is the amount that we need to record on the debit side of our provision for depreciation under the heading of disposal. And the date is 31st July 2021. Let's write it down. So that's 31st July 2021. Disposal, and it had the provision for depreciation of 790. Okay, now we need to also record the depreciation charge for this particular year on the credit side. So we can just put the end date, which is 31st July 2021, and we can term it as the income statement since we record the depreciation for this year in our income statement. Okay, since we know that the depreciation is to be charged using a reducing balance method, we first need to list down all of the cost of our machinery and then subtract the provision for depreciation from that particular cost and then apply the rate of 20%. So let's list our cost. So the opening cost was 26,800, right? Then we disposed of a machinery which had the cost of 2,500. So this should not be included anymore in this cost. So we can just subtract it. Then again, we disposed another machinery which had the original cost of 850. Again, since we already disposed it, this cost should not be included while calculating the depreciation for this particular year. So we're just going to subtract the amount of 850 as well. Then we also purchased a new machinery, right? So we purchased a new machinery costing 4,200, and this should definitely be included in the cost while figuring out the depreciation charge for this particular year. So let's add the 4,200. Okay, this concludes our cost section. Now we need to subtract the provision for depreciation. So the original provision for depreciation was 12,200. We need to subtract it. Then we also know that the part exchange machinery, which had the cost of 2500, also had the provision for depreciation of 900. And since we already disposed it, this provision for depreciation should not be included while calculating the depreciation charge for this year. So we are just going to reduce the amount of 900, which is the provision for depreciation of the disposed asset. Again, we repeat the same process for another machinery which had been disposed. So it had the provision for depreciation of 790. Right, so we also need to reduce it from our provision for depreciation while calculating the depreciation charge for this particular year. So I'm just going to subtract the 790 as well. All right, this concludes the provision for depreciation section. Now we will charge our rate. So we're just going to multiply it with the rate of 20%, which we can write it down as 0.20. Okay, so the depreciation charge is just going to be 26,800 minus 2,500 minus 850 plus 4,200 minus, and the remaining terms are under a bracket. So that's going to be 12,200 minus 900 minus 790 times 20%, which gives our depreciation charge for the year to be 3,428. So we need to record this amount in our credit side of the provision for depreciation under the heading of income statement. Let's do that. Okay, so this concludes everything that needs to be recorded. Now we just need to figure out our closing balance. So closing balance can be written down on the closing date, which is 31st July 2021, and we can write it down as balance CD. In order to figure this out, we first need to total the credit side, which is going to be 12,200 plus 3,428, which gives our total to be 15,628. So this total must be the same for debit side as well. Now the closing balance acts as a balancing figure, and whenever we're trying to figure out the balancing figure, we subtract all of these amounts from the total. So in this case, that's going to be 15,628 minus 900 minus 790, which gives our closing balance to be 13,938. Alright, now the last thing we need to do is list this closing balance as an opening balance for the next year. So we can just use the date of 2021, August 1. And we can write it down as the opening balance, balance BD, and it will have the same amount as our closing balance. So that's going to be 13,938. Okay, so this concludes the first part. Now we can move to the second one. For the second part, we need to prepare the disposal account for the year ended 31st July 2021. So for disposal account, we always record the original cost of the disposed assets on the debit side. Then we record the values that we got for the disposal. So we record the provision for depreciation plus the value that we got in exchange of the sales made of the already existing assets, right? And then we figure out whether there was a loss or profit on disposal. So if there is a profit on disposal, that will be recorded on the debit side. And if there is a loss on disposal, that will be recorded on the credit side. Okay, now let's start by recording our disposed assets at their original cost. Let's have a look at the above information. So for the machinery that was disposed on 1st January 2021, the cost was 2,500. And for the machinery that was disposed on 31st July 2021, the cost was 850. So these two costs are to be recorded on the debit side in our disposal account. Let's do that. So firstly, we had the date of 1st January 2021. And we are recording the plant and machinery. And we're recording it at cost. So it had the value of 2,500. We repeat the same process for the asset disposed at 31st July 2021. So again, that's plant and machinery. We are recording it at cost, and that was 850. Alright, now we just need to record the provision for depreciation. So let's just write down the same date for 1st January 2021. We are again writing down the plant and machinery. But this is the provision for depreciation. Let's have a look at the provision for depreciation account. So for 1st January 2021, we had the provision for depreciation of 900. Let's write it down. Then if you remember correctly, this plant and machinery was actually part exchanged, right? And we already discussed the value. So we purchased a new machinery which had the cost of 4,200, and this was settled by a check of 2,450. So if out of 4,200, 2,450 was funded by the check, then the remaining amount was funded by the machinery, which means that the remaining amount is the value that we got in exchange of the machinery. And the remaining amount was 1,750. So this is the value we got in exchange of machinery. So this should also be recorded on the credit side in our disposal account. Let's do that. So the date is just going to be 1st January 2021 again. And we're talking about plant and machinery. And this is the cost at which we sold it, right? In a way, part exchanged it. So it was 1,750. Now we just need to record the provision for depreciation of the asset sold on 31st July 2021. So that's plant and machinery. And we're recording the provision for depreciation. Let's have a look at our provision for depreciation account. So for the asset disposed on 31st July 2021, the provision for depreciation was 790. Let's write it down. Okay, now we just need to total both sides and figure out which one is the heavier side. So let's calculate it first for the debit side, which is going to be 2,500 plus 850, which gives a total of 3,350. For the credit side, that's going to be 900 plus 1,750 plus 790, which gives the total to be 3,440. So clearly we can see that the credit side is the heavier side. So that will be the balance for both of these sides. Then, like I said before, if the balancing figure is on the debit side, then that indicates the profit on disposal. And this profit on disposal can be recorded at our ending date, which is 31st July 2021. And we record it under the heading of income statement because this profit on disposal is to be recorded in our income statement. And now this acts as a balancing figure. And whenever we're trying to figure out the balancing figure, we just need to subtract these amounts from the total. So in this case, that's going to be 3,440 minus 2,500 minus 850, which gives our profit on disposal to be 90. Okay, this concludes our second part. Now we can move to the third one. For the third part of this question, we need to discuss the reasons why a business may choose to depreciate plant and machinery using the reducing balance method. Alright, firstly, depreciation is charged to comply with the matching or accruals concept, right? Let's write that down. Depreciation is charged to comply with the matching or accruals concept. Secondly, if we're talking about the reducing balance method, under this method, the depreciation is charged higher in the initial years because during the initial years, the net book value is pretty higher compared to the later years. Let's write it down as well. So reducing balance method charges higher depreciation in the initial years and we're talking about plant and machinery, right? So this actually matches with it because plant and machinery are likely to be used more frequently in the earlier years, or we can say that plant and machinery is more productive in its early years. And since charging a higher depreciation in its initial years is actually justifiable. So let's write it down. This matches with the fact that machinery is likely to be more productive in its early years. Okay. Then lastly, this ensures that the value of plant and machinery is more realistic as the depreciation charge matches with the productivity from the machinery and represents a true and fair view. Let's write it down as well. This ensures that the value of plant and machinery is more realistic and represents a true and fair view. Alright, this concludes the third part as well as this question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.